Right, hello everyone, and welcome to today's panel discussion. My name is Fran. I'm a professional futures trader myself, and I'll be your host today. We have some wonderful guests today here, real professionals. I hope you all enjoy. And we're going to talk for about 45 minutes-ish, and then we're going to have a Q&A session for all your questions. Firstly, we have Pavel here from Vincent, Algo Trade's main partner, as you know. Wesley from IMC Trading, our silver partner, and Kresho from Intercapital, our gold partners. Pavel, I'll now give the word to you. Tell us a bit more about yourself and your company.
So my name is Pavel. I've been working for 7 months at Vincent as a quant trader. My previous backgrounds were maths, computer science, machine learning. And a few words about the company. So we've been existing on a crypto market for 7 years, and we specialize in market making on spot markets, crypto derivatives. And besides that, we also do OTC trading, which is like over-the-counter trading.
Something, Mike? Hi, everyone. So my name is Wesley. I'm from Amsterdam in the Netherlands, and I'm a trader at IMC Trading, where I've been trading for about 3 years now. So IMC Trading has offices over the entire globe. So we are present in Amsterdam, but we also have offices in Chicago, in London, in India, and in Sydney, in Australia. And we are basically trading all the equity derivatives that are present around the entire globe. So that means commodities, but also index products, ETFs, options. And we are a specialized proprietary trading firm specialized in options. My background is in mathematics. I've studied mathematics in Amsterdam as well. And I also hold a master's in artificial intelligence.
Thanks. I'm Kresho. I'm based here in Zagreb. I work at Intercapital, an investment group based here in Zagreb as well. We've been active for roughly 25 years. I've been with the company for 13 years, so they definitely feel way too old for this panel. We're involved in several businesses, basically brokerage, broker-dealers, asset management, advisory, and also prop trading.
Cool, thank you guys very much. Let's now start with just a warm-up question. How would you define the role of the derivatives in today's markets? What's their purpose, and what do we even use them for?
So I actually draw like two main purposes of derivatives. So the first one is speculative. So if you want to make some speculative bets on some markets, then because of enhanced liquidity on financial derivatives markets, you can basically do something cheaper and at a better scale. So that's the first role. And the second role of those like derivatives, like including like futures, options, is to hedge. So in particular, like in crypto market, where there are lots of crypto projects, investors themselves cannot sell the coin after first 6 months to a year, maybe 2 years. So basically, they can't do anything with the investment. But what they can do is they actually can enter some short position on, for example, on perpetuals markets in order to hedge against future price movements. So that's one thing. So that's protecting investors and hedging.
Cool. So kind of like, let's say you had that P network was pretty popular among everyone and they couldn't sell, but then there was, I think, P derivatives where you can like hedge your position, wait for your coin to arrive and then exit the position. Nice. Okay. Wesley, the word is yours.
Yeah, thank you. So I think the most important part about capital markets in general is to provide fair pricing for a lot of underlyings for price discovery to happen instantaneously. And I think derivatives play a key part in that. And that's because we don't have the sole liquidity on the instruments themselves, so for example in a particular stock, but we also want to know or understand what the upside risk is for particular stocks or commodities or price instances. And the same thing happens with downside risks on a bunch of equities. And derivatives allow to both take a speculative bet on that, but also to make sure that firms or pension funds or sole investors are hedged for their risk and make sure that they are taking the risk-reward situation that they actually want to get. I think derivatives are key in making sure that the price discovery is fair there.
I would just maybe add, it depends on what your mandate is. So basically, the guys are maybe talking from a trader's perspective, myself more from a long-term investor's perspective. So basically, we use derivatives as a hedge potentially of the underlying exposures that we have. Sometimes for income generation, like looking for additional alpha through income generation. But at the end of the day, it just depends on the mandate. It depends on what your idea underlying is, and then you can just use derivatives in combination or exclusively to just get the best and most efficient exposure to a particular theme or investment idea or whatever you're trying to achieve or what your mandate is.
Great, thank you guys. Okay, now let's get into the spicy bit. So if you could give us an example of your day-to-day operations, and if you could briefly just describe how your firms use derivatives in practice and what you do with them, and some maybe interesting cases you had in your career.
Yeah, so as I said, like we market make on derivatives, so we actually provide liquidity for perpetuals on cryptocurrencies. Just for those who don't know what a perpetuals is, you can think of it as a future that does not expire. So just for context. And yeah, so aside from market making, we also do over-the-counter trading. And as a more detailed example of over-the-counter trading, for example, someone sells us, so someone sells to us, we buy lots of spot cryptocurrency, which is not a financial derivative by itself, but as you know, selling lots of spot currencies can be, in one moment can be really expensive. That's why we use financial derivatives, namely perpetuals, to hedge against future price fluctuations. And I think this is particularly important when someone is a bit informed. So someone knows that the price will go down, so someone sells lots of cryptocurrency to us. And our role is to hedge as fast as possible to protect ourselves against potential losses. Yeah, I think that'd be pretty much it.
Just a follow-up question. Do you ever have problems when you have to hedge as fast and there's not enough liquidity or something, and then you have to incur losses? That happens sometimes?
Yeah, obviously. An example of that is, some coins are so small or not so well explored that there are no perpetuals on, for example, on major exchanges like Binance. And this is a bit of a challenge on how to price, this particular trade efficiently. It could be a multiple of reasons. So liquidity on that spot market is small, and executing the OTC trade would have huge impact on the price, and it would be actually pretty stupid to just sell instantly. Yeah, so then we need to resort to different approaches on how to sell all the stuff more efficiently.
Great insight. Thanks, Wesley, please.
Yeah, thank you. So, as a market maker, we are present on basically all equities in the entire world, where we are focusing mostly on the option spaces. That means that we are trading based on our volatility edge or our perceived volatility edge. So we make sure that on all equity markets we are constantly present with what we call a bid, which is a price that we are bidding to buy, and with an ask price, which is the price that we are bidding to sell. And we have also obligations to all the entire market participants that we are actually going to be having firm quotes. That means that people are always willing to sell or buy at these specific prices. So we are now providing liquidity to the markets 24/7 on some of these markets. And of course, with that comes great risk as well for us as a firm, because at all times we are there present with the price, and everyone in the entire world sees our pricing and is able to trade with us. So we need to make sure that our volatility models, our pricing models, our research analysts, our event pricers are all really good and are really up to date, such that we have the fastest updates in our systems and that we make sure that the pricing we are providing in the markets are fair. And we can just provide liquidity in that sense. So a very interesting example, what happened a couple of months ago, was a global-wide energy outage or a CrowdStrike risk that we had. So basically all Windows systems were down in the entire world, which meant that a lot of exchanges even were out. There were no bids and quotes, there was no liquidity, no volume on traded markets. And we have a bunch of backup systems available, such that in these events we are still pushing our trades, our bids and offers to the exchanges, such that people in the entire world can still hedge their risk, can still make a trade with us. So it's really key for us to be always present with buying and selling prices to provide the market with the liquidity. That's our goal and also our ambition.
Cool. I just have one follow-up question for you. So when you say you're always there in the order books, does that mean like 100% of the time, or are there some nuances apart from the power outages where you are not there, perhaps when there's a huge volatility event or something like that?
Yeah, so it's our goal to be there, well, practically at all times, but of course there are some specific set of rules, such as a power outage, then the entire world is flat. So it is okay if we miss a little bit of liquidity during these excessive times, but it's our goal and our ambition to be there 100% of the time, also because that serves our need as well. So we make algorithms, we make our systems so robust that we are practically, let's say 99.9% of the times they are present with buys and sells.
Yeah, from my perspective as an asset manager, we usually look at it a bit differently because we tend to own the underlying. So basically, if, for example, it's an equity strategy, let's say US large cap, something like that, then what we would do is basically try to either hedge or enhance the return by using derivatives, whether simple strategies like, I don't know, collars or covered calls or something very basic, whereby we kind of reach an investment decision. Okay, we think the market is overvalued, so there's an opportunity in trying to, let's say, enhance the return by capping the potential upside or protecting against the downside, or funding the downside protection by capping the upside using derivatives, using options. But the main difference is that we have an investment idea, a goal that we try to achieve, and basically combine the underlying with the derivatives to try to achieve the best possible outcome with the least amount of volatility.
Cool. Thank you, Krish. You can keep the mic. I'm gonna ask you this next question. So Warren Buffett, one of the greats, he called derivatives weapons of mass destruction in one of his speeches. Why do you think he said that? And would you say that derivatives can amplify market volatility? And if yes, how so?
I mean, for sure they can amplify market moves. Obviously, as the volumes on the derivatives market get larger and larger, the impact of the derivatives market is becoming more noticeable on the underlying market, and for sure, it's something that has become very important for the global markets, and is something that is very much worth following, and basically can at some point even uncover some hints maybe on where the market is headed. With respect to the mass destruction idea, I think this is this stems more from back in the day when even the derivatives market was not as regulated as it is now, and it wasn't maybe even as understood, and maybe even the risk pricing wasn't as efficient as it is now. I would say that even though the volumes are higher now, I would say that it's more sophisticated, and the participants are more educated on it, and that there are guardrails created from a regulatory perspective to avoid any huge, let's say, blow-ups. But I mean, as always in markets, there are risks associated with it, and I mean, you never know when something can come up that has never happened and no one really envisaged it before, to create some sort of a guardrail against it. But I wouldn't go that far to call it a weapon of mass destruction.
Okay, thank you very much. That's interesting. Wesley, please.
Yeah, I think it's really important to take the context at that time into account regarding Buffett's quote. So I think he made the quote the first time in 2002, which is right at the dot-com bubble moment when the markets were bursting. Back then, like this pre-2008 time frame, the regulation was a lot less strict in terms of derivative space, in terms of margining on accounts, in terms of being able to go into debt in order to finance your derivative trading. So yeah, back in the days, there was a lot more risk involved with trading on leverage and trading derivatives. So I think the markets have shifted such that we now have centralized marketplaces. We have a bunch of safeties. You need sufficient margining in order to finance your trades. So in that sense, the risk or the mass destruction risk that Buffett was warning everyone about has dampened a lot. And I actually think that derivatives allow for a much faster price discovery than just the sole underlying, given that not everyone is able to trade the underlying or is showing what a potential risk is in a particular underlying. Underlyings are too one-dimensional for that, and you need at least derivatives to capture option spaces, for example, to see your potential upside and downside risk, to capture the second-order effect of market risks. So I think derivatives will actually dampen the amount of excessive market risk that there is, but of course there's also some extra volatility that could be induced by specific derivative trading, especially if you do not have enough margin or if there are not enough safeties. But in current day and age, luckily there are a lot of safeties in place to prevent that.
Great, thanks. So we're going to get into the technology advancements later. Pavel, please.
Yeah, so, okay. Yeah, so I think there were like two perspectives. In the first perspective, you use derivatives purely speculatively, and obviously it could be a distraction. One of examples from Poland was that during like 2008 times, like US dollar compared to Polish currency was going down, and many Polish companies were betting on the currency going down again. So everyone was buying like put options or was selling call options. And afterwards, you know, the currency, like the exchange rate between US dollars and Polish zloty actually increased, and many companies went bankrupt. But I think this is mostly because it was like those derivatives were used without care and mitigating any, you know, like risk management limits. So yes. But besides that, if derivatives are used like in I don't know, like in HFT, then the only thing you care about is to keep enough collateral so that you're not liquidated. So I think if like in HFT role, as long as you manage to keep enough collateral, then it's fine. But once you're out of collateral, then well, liquidation happens, and that's what you want to avoid.
Cool, interesting story. Didn't know that about the US dollar Polish zloty currency pair. Okay, so now moving more into the speculative part, as you said. Question for Krešo. So with the rise in popularity of 0 days to expiry options, have derivatives evolved more into the speculation tools? So more into the speculation than actually the risk management instruments? What do you say?
I mean, with zero DT, it depends. So basically, it's become popular in the retail space, and I think even like generally trading options has become way more popular in the retail space since COVID and since kind of the rise of a lot of digital, easy to kind of get to platforms. And basically, I think in that space, it's treated as very speculatively. But on the other side, on the institutional side, I would say that institutions can use it to kind of fine tune their hedges, maybe express some sort of view on a near-term event like a data release or an earnings release or something like that. I actually read a statistic that most of the volumes is still made by institutions, and on the other hand, that the retail usually loses money on zero DT options. So I guess it depends. It can be very speculative, but it has its purpose, and it can be used as any other derivative as long as there's some underlying strategy behind it that this is a building block for. But if it's just pure speculation, like short-term gambling, then okay, yes, it can serve that purpose, but I don't think it's the main purpose.
Yeah, of course, it can definitely be used as a speculative source or a speculative tool to engage in the zero DTE trading. But at the same time, I do think there is a very practical use also for institutions, but for companies to hedge their risk in zero DTE options. So an example is an airliner. The biggest cost of an airliner is fuel cost, and that's heavily governed by the oil price. So if there are any events that are happening tonight or in the day after that are governing this oil price, then an airline does want to mitigate these risks in oil price space. So for example, if there is an OPEC meeting where they are discussing potential oil output, then an airliner might want to actually reduce their risk by, well, hedging in option space, in derivatives, for this sudden move in the oil price to not be dependent on a sudden influence. And if the zero DTE option was not available, but they could only trade a monthly option or an end of month option, for example, then they could not get the actual risk for this particular event. So I do think that having zero DTE options is a great tool for a lot of institutions and companies to hedge their day-to-day risk. But at the same time, it can also be used as a speculative tool to make sure that you are going for a specific direction in underlying space. But I do think there's a very practical use for institutions as well.
Great, thanks. I like the examples in the real world you're giving us. Thanks, Pavel.
Besides speculation, I think that zero day to expiry options are like dangerous for retail, and the main benefit comes from institutions. And well, there are like a couple of reasons. First, like retail clients don't have as much information as institutions. And secondly, options are like kind of more complex instrument compared to futures. I would add like same thoughts as you guys, but I want to be repeating, and I don't have much experience in trading zero day to expiry options.
Okay, thank you guys. Moving on to our next question for Wesley. So how do you see the derivatives market evolving in the next 5 to 10 years, particularly in the response to technology and AI? We've had algos for decades now, but they are just recently becoming more and more advanced. They're advancing faster than ever. So how is the derivatives trading changing in that regard, and will these technologies make market more stable and efficient or not?
That's a great question, thank you. So I remember back in the days, I'm not sure if you've seen any movies as well about this, but that's the pit floor. So that's what usually options trading was all about. it was a grand scheme of things. So a lot of people gathered in a specific room, and then you were manually agreeing to a deal with one another. So maybe some person at the total other side of the room wanted to buy a put option from you, and you wanted to sell it. So you literally had to, well, either through hand signs or through direct shouting, had to make sure that you agreed to a deal. Nowadays, of course, almost all option trading, but trading in general, happens with technology, over the cloud, with computers, over the internet. And that change is exemplified with the upcoming stream of using of AI tools and of increases and improvements in technology space. And I think that will keep on happening. So we see, for example, that price discovery is happening at an increasingly pace, and that's due to the increase of LLM models such as ChatGPT, OpenAI, but also a lot of other LLM models that are really fast and really good at reading through a bunch of documents, for example. So if a company releases a text statement, back in the days, we might have needed a couple analysts to go over all the different pages, read the entire book of papers that was released. And nowadays, an LLM can real quickly identify the key points in such a document and can highlight it to an analyst and make sure that the price discovery happens instantaneously. And then, of course, there's still a lot of value in an analyst, as in to interpret these numbers. Maybe there are some side notes, maybe there's a small mistake made by the language model. But in general, the rise of AI can really help in faster price discovery, better algorithms, and therefore also fairer prices for everyone to invest.
Cool, thanks. Can you pass the mic to Krešo? Thanks.
Yeah, I would say, I mean, it has a huge impact on the whole investment universe. So basically, as Wesley said, I mean, from an investor's perspective, I mean, it gets much easier to analyze huge amounts of data, to go over earnings reports and different kinds of reports, making price discovery faster, making investment decisions more informative, and then, of course, you can always express your investment views using derivatives. And the other point of view is from a market making perspective. Guys can maybe speak more on that, but efficiency in terms of derivatives pricing, market making, making potentially using advanced, let's say, tools to make the spreads more narrow, to make more and more instruments as liquid as possible. Also arbitraging out potential anomalies in the market, because using machine learning and large data processing, it just gets faster and easier than before. So I think now with the rise of AI, this is just going to keep progressing as it has been progressing for the last, I don't know how many years. Yeah, I think trading overall is going to become more and more algo-driven going forward. But still, at least my personal opinion is that there still has to be some sort of, for now at least, a human who would kind of pull the dots together and have some sort of an informed view of what happens, and not just a machine trading on signals. But I guess at some point even that will be able to be done by the machine.
Would you say it would also take some jobs out of the financial markets? Let's say dealers could maybe become AI dealers without humans.
I mean, yes, for sure. I think a lot of operations in the finance industry are going to become more efficient. Whether that necessarily means less jobs, we'll see. Maybe just the volume of activity increases with the same amount of people. But I would say that the financial industry is one of the industries that is at quite a huge risk of being somewhat replaced by AI. And this is especially, unfortunately, for junior sort of roles at first, which is something that is kind of short-sighted, because if you think about it, okay, junior roles in any industry, even like for developers and so on, it's the easiest thing to replace. But if you replace all juniors, then eventually you run out of seniors, but that's a concern for someone else, I guess.
Like, good luck to them.
Yeah, so I think there are like two perspectives on that. The first one is more from a trading perspective. Second one is from more retail consumer perspective. So regarding the trader perspective, I think that lots of trading shifts from like simple to more complex models. There was a huge rise in reinforcement learning recently, partially in large language models, but I believe that that rise was also it's happening in trading. And I think that a role of traders the job of traders won't go extinct, but it will shift towards more ML-oriented trading. So I believe that might be happening. And regarding the consumer/retail perspective, there has been also like a huge rise in AI agents, and AI agents started to do like many things, and one of them is payments. However, I think there was lots of regulation from the EU, from governments in order to be passed, so that AI agents use banking accounts to do transfers. So a natural currency for AI agents to actually make some sort of payments, it seems that it's crypto, because it's maybe unregulated, but it's not regulated enough so that AI agents couldn't be making payments automatically. And an example could be, you're telling an AI agent to book a decent room in that area from 5th June until 15th. And the AI agent could be actually able to do everything by themselves.
Maybe if I can just add one more thing, when you mentioned regulation. So basically, the financial industry usually kind of fights against the regulation. That's kind of the normal state of things. It always wants to be less regulated, obviously, because then you have more opportunities to make money. You can use less of your capital to make money and so on. But for example, in this case, I think the regulatory framework can act as some sort of a moat for the financial industry, because it's going to definitely slow the adoption of AI into the industry. And I think in the sense of preserving jobs in the same shape and form as they are now, I think regulation is going to help, if this is helpful. But if you look at it from a preserve the job perspective, I think the regulation is going to slow the adoption, especially I would say here in Europe, because the advancements in AI are so fast that it's almost impossible that the regulation can follow it in the same pace.
Can I add something real quick as well? Yeah. I think the rise of AI will not necessarily replace the jobs, similarly as, I'm going to use an airline example again, but the same thing as artificial intelligence is also helping pilots. So for example, the autopilot feature on a plane will help a pilot massively in making the best decisions while in an airplane. But at the same time, we do not want to replace pilots in general. Like, we want the pilots to work together with the autopilot. And I think a similar thing will happen with, in this case, for traders, for example, truly from the trader's perspective, is that the auto trader will use a lot more AI. So artificial intelligence and more sophisticated systems will help improve the trading, but at the same time, it will still be the trader's role and the trader's perspective to help guide the trading with the AI. Similar as a pilot is flying a plane with AI instead of the AI replacing the pilot in general.
Great, thanks. So we just touched upon regulation, and it's actually going to be my next question for Pavel. As we know, Vincent is specialized in crypto. So I'm interested in how do you maintain pricing and efficiency, and how do you manage risk in such a 24/7, forever volatile and even manipulated market?
Yeah, that's actually a good question, because it might be challenging to, to maintain this risk monitoring and price efficiency 24/7. but obviously we rely on some automatizations, such as like automatic price discovery, automatic price computations, and it's all done by algo. So that's one thing, automation. And second thing is coverage of all hours. So we have coverage in like Europe, Asian hours. So that helps to maintain like 24/7 supervision of the algorithms. And well, the third thing that actually many companies use is, for example, Tweet Listener, or like X Listener. So many tweets can have huge impact on the price markets, so on market's price. So imagine like the most famous example is like Elon Musk saying, or like Donald Trump saying, I'll make national reserve and specifies 3 currencies. So obviously the price will jump up, and role as a market maker while price is jumping is you want to avoid being being bought being sold while price is increasing, because in that way you lose some money. Yeah, and I think last thing is that we have like 7 years of experience in crypto markets, so we have lots of data to backtest. Yeah, and I think that helps a lot.
You mentioned the tweet listeners, right?
Tweet Listener, yeah.
Can you set me up with one of those? Might help with my trading as well. We'll talk about that later. Okay, moving with regulation. So as we know, derivatives are generally very standardized and regulated products, and now they're becoming increasingly popular in crypto markets as well. But of course, they're not as regulated as regular derivatives, let's say. So are there any challenges to these products? Are they properly regulated? Are the regulators keeping up? And would you going back to that question of speculation versus hedging, would you say that the crypto derivatives are mainly used for just speculation, or is there a significant amount of volume just for managing risk?
I'll start with answering the second question, because the answer is a bit easier. So I think I don't have a strong opinion. I think that well, derivatives are used both for speculation and hedging. Yeah, I don't have like any strong opinion on that. But regarding the regulations, so like financial derivatives, in crypto financial derivatives, the most popular derivative is perpetual, which is this future which never expires. And the only regulation is exchange regulation. So exchanges are responsible themselves for setting up the rules how perpetual is constructed. So futures across many markets are sort of like unified in terms of like input variables. However, it can differ for like crypto exchange. So that's one thing. And an interesting fact is that in Australia, a stable coin is classified as financial derivative. So this is a bit funny, but yeah, this is true. Yeah, thank you, that's it.
So just a follow-up question. So basically the whole trust in the derivatives that are issued by crypto exchanges is in the crypto exchanges themselves. So there's not a third regulatory party regulating them, right?
Yeah, so it's like obviously not as heavily regulated as in the like commodities or equities market. I don't know the exact border. There is some small regulation from governments, but exchanges themselves have like enough freedom to adjust those financial derivatives. But it's also worth mentioning is that it's in the interest of exchange to be as reliable as possible, because if the exchange turns out to be unreliable by, for example, providing like perpetuals with very weird definitions, very scummy definitions, then obviously no one is going to trade on that exchange, and well, that equals bankruptcy for that exchange.
Great, thank you for the insight. Now moving to a question for IMC and Wesley. So with the rise of unexpected market events in the recent months, we saw macro shocks, political risks, sudden news like Trump tweets. We saw Israel's attack on Iran last night. So how does that influence your ability to hedge and price risk accurately? And would you say that these events create more risk opportunity for you, if they create more risk for you or more opportunity? So would you prefer a more volatile markets or maybe more peaceful markets?
Ooh, that's a great question. It's also not so easy to answer that one. And it also changes a bit because we are a market maker. So purely taken from a purely market making perspective, that means that we always have to be quoting there. And we also need to make sure that our pricing is correct. But in such volatile environments, so for example, if Trump is tweeting something, or with the Israel attacks that we saw last night, what is done a fair price? Like, there's no true price at that point. No one knows. The entire world doesn't know what a fair price is for a stock option or for the Apple stock. And we also don't know, but we do have to price it because that's our obligation. We need to make sure that we are still able to buy and sell. And that's why we need the best algorithms, the best developers, hopefully also the best traders in the world, to make sure that we have the best possible price given the circumstances. And that is quite tough. So we are putting our prices out there, even though we also don't truly know what a fair price is for a particular underlying or a particular derivative. But we need to make sure that our pricing is the best to our ability at those moments. So events like Trump tweeting or attacks in the entire world, quite sad, obviously. But it's also our mandate to provide a price under any circumstance. So we need to make sure that we change our pricing such that we have a fair equilibrium in the market again. And in that sense, of course, if there is a lot of volatility, that also means there is a lot of volume on both sides, so both on the buy and sell side. And as a market maker, we profit then on the spread between the buy and sell price that we quote. But at the same time, if the market conditions are quite, there's not much volatility in the market and prices are quite stable, then we might be able to provide a tighter spread, which makes people more willing to trade with us. So in both environments, we're able to make money, we are able to provide prices, but the environments themselves are really different, and that's also why we need very versatile algorithms and traders as well.
So if it's not a too sensitive question, would you make more P&L during the volatile phases or the more peaceful or stable phases?
I think in general, as a market maker, we are not unhappy with volatile environments, but at the same time, it does really depend on market volumes as well. So if there's a lot of volume going on, then on the volume, yeah, it's possible. But if at the same time, there's also a lot more risk for a market maker if there are volatile conditions, because if our pricing is off, and it is from time to time, then there's also a lot of downside associated with it. So I think high volatile environments provide a high reward scenario, but also comes with it high risk.
Great, thank you very much. And last question for Krešo. So as we know, Intercapital has done tremendous work in bringing ETF investing closer to our region. I definitely recommend to the audience to start investing no matter how small amounts, especially when you're young. So do you ever incorporate derivative-based ETFs in your portfolios? Would you ever recommend an derivative ETF to your clients? And if you give us a picture, how does this work?
Yeah, so basically, as I said, we're a financial group, and we just recently, maybe just for context, sold part of our asset management business and basically carved out some of the stuff that we decided to keep. One of them is the ETF business. So currently, we operate 5 ETFs. Most of them are focused on the region because we feel that this is kind of our specialty, and therefore the answer is no. We don't currently have derivatives based or ETFs that incorporate derivatives, which is not to say that we won't have them in the future. So for now, we are focused really on the region and to promote the region as an investment opportunity, because we are quite committed to this market and of strong belief that it's really provides with investment opportunities. But going forward, I think some of the trends in the ETF market overall show that the rise of in popularity in actively managed ETFs, so basically active strategies that are just using the ETF wrapper as a vehicle to gain access to a broader universe of investors. Recently, we've seen a rise in popularity also in ETFs that incorporate some sort of a derivatives overlay, be it just simple covered calls or some collars or something like that. That can lower the volatility of the product. I mean, it depends on what you try to achieve by investing in those ETF, whether they make sense or not. If you're very young, as you said, and want to invest in the long run, then I guess it's better to kind of have a Delta One exposure without any kind of derivatives overlay, but maybe combining it with some other strategies can make sense. Also, I think after kind of the initial rise of the ETF industry, some of the second or third tier competitors started competing by offering not physical replication but synthetic ETFs that use total return swaps to achieve exposures, because total return swaps can sometimes be more efficient than physically replicating the underlying securities due to trading costs, due to some tax efficiencies in some jurisdictions, and maybe some collateral management potential that can achieve a very, very small alpha that can then in turn lower the total expense ratio of the fund. But okay, in turn it comes with some risk, because the fund doesn't own necessarily the underlying securities, but it's involved in a swap with a certain counterparty, so you have some sort of a counterparty risk. But my point is generally that the ETFs are here to stay, and the trend of ETFs is rising. And I think in the future we're going to see ETFs becoming much more than just passive trackers of certain indices, but also actively managed funds and so on. And I think even in our portfolio of products going forward, we might see maybe firstly synthetic structures which replicate some sort of exposure in a synthetic way and not through physical replication. But in the future, maybe also something that has some sort of a derivative embedded. We'll see. So in short, for now, no, but in the future, quite possible.
Great, thanks. Okay, so this is an end of our panel discussion. We're gonna go to our Q&A session now, and I'm gonna break the ice now with the first question. I'm sure you're all interested. So what advice would you guys give to a student from a STEM background looking for a career in finance?
I wanted to begin that, well, I will speak on like from trading perspective. So this career is like really rewarding, because job is extremely exciting, and I can't imagine now working in other field. However, one thing to keep in mind is that there was lots of pressure in the work, and that's one thing you should always remember. And speaking about advices, so well, these interviews are all about solving, like questions about expected value, about probability, and the most important thing for us, in order for you to safely hire, is we want to be sure that you're fluid in calculating correctly expected value, dealing with probabilities. And the last thing, which I think is very important, is to make decisions under pressure. So when there are especially like volatile times, and you need to make decision, you need to be decisive in that. You need to basically do that. Sometimes you don't have enough time to think, and here where pressure comes. So yeah. So when you excel in expected value probability. And then if you manage to do everything super fast, super quick, then I think it's a very good start to begin the career.
Yeah, thanks. I can definitely agree on the excitement part. Is definitely a dynamic career because you're operating in a dynamic, ever-changing environment. It's never the same, so it's never a dull job. Yeah, Wesley, please.
Yeah, so I think it's like if you have keen affinity with the financial world or with mathematics, which is a very important part of becoming a trader at IMC or working in the developer space, then I think you should embrace the inner nerd that you are maybe potentially. We are looking for the brightest individuals in mathematics that excel in math and that really like to work in a trading environment. So of course, if you have affinity with mathematics, if you enjoy solving analytical problems, if you like to think about probability theory, about expected values, about potential scenarios, then of course that all helps you to become a very good trader or to be a potential candidate for IMC trading. But in general, I think you should go after your dreams and go after things that you like. So if you would like to work at a trading firm, then go for it and give it your all. Embrace the maths, embrace the story or the path that will take you there. Go for it, give it your all. I think that's the most important part, and never give up. Working at a trading firm, for me, is a lot like playing at a football club, for example, or playing in a sports team in general. So together you will try to make the best performance possible, and some people are really good at scoring a goal, some others are really good at defending in general or passing the ball around. So make sure that you specialize on the thing that you are very keen about, that you like a lot. Make sure that you become the expert in that field, and then all the teams in the entire world will want you on your team, and that's the most important part.
Great, thanks. I like the sports analogy as well. Christian.
Yeah, I mean, having a STEM background in mathematics, and I think for our kind of a trading role is crucial. Maybe just to touch on a kind of different aspect from an investor perspective. I think this kind of background is becoming more and more important, and I think you can be well prepared coming out of this university or a similar university. You can be well prepared for such a role, but I would encourage you, if you want to explore a role in investing, let's say, to try to broaden your interest and to try to learn as much as you can about the history of financial markets, about the world overall, and basically to try to get as best of an understanding as you can of the events shaping the global markets, and to just be able to combine kind of this let's say analytical mathematics-based expertise with a strong understanding of the world around you and some historical precedents that were similar to something that you're seeing in the world today, and to try to make sense of it. I think this will take you far, the combination of the two.
Okay, thank you guys. Now, is there any questions from the audience?